My name is Ben Powell. I work in SEB's Climate and Sustainable Finance team. My background is that of a borrower of capital. So I moved to Norway about 15 years ago, started to work in Kommunalbanken. So in the Treasury Department, so essentially borrowing money to fund the municipalities and counties of Norway. 2010, we were one of the first agencies, in fact the government agencies, to launch a green bond program. So I've got had pretty good knowledge of the system in Norway, of the municipal system, and actually worked quite closely with Enova when it came to connecting our bond program to the lending program in Norway. From there I moved to the World Bank, where I was working in Treasury, and again working on social and green products and financing that through green and social bonds. So my background is that of a borrower. About a year ago I moved back to Norway to work for SEB in the Climate and Sustainable Finance team. So some say I moved to the dark side, but I like to think I moved to the green side. So really that's just a little bit of my background, and really as has been discussed, really how are we preparing ourselves for companies? How are companies preparing themselves for the future? And that's why I thought, when I thought about who's going to be able to raise capital, who's going to be raising capital competitively, cheaply, or expensively in the future. And there's two things I thought about. One is this expression in English where we say, fail to prepare, prepare to fail. And I think there's an element of this should all companies be thinking about how they are preparing for the regulation that we know is coming, the pricing that we know is coming, this reallocation of assets that Larry Fink is talking about. That's a big investor right there talking about, okay, we are going to be incorporating ESG in our decisions, and so that is going to affect where I am putting my money. So if you're not a company, if you're a company, you really need to be thinking about, are you prepared for this transition? Are you prepared for investors reallocating capital? The other thing I thought about was the title that you heard earlier, which was the end, or the general corporate purposes. This is the end of general corporate purposes. So if you think about every loan document, every bond transaction, if you look at use of proceeds, for many years, use of proceeds, you just used to say, how are you using the money in the documentation? It would be general corporate purposes. And I really think that's not good enough anymore, and that investors are really asking for, okay, what are you going to do with my money? What is the impact of my krona? I want to see what you are doing with my money. And really, that's why I think we're going to be moving away from general corporate purposes to much more disclosure. And that's really happening. And I think the green bond is the first real instrument that started this dialogue, that opened the door for this discussion between investors and disclosure of companies about what they were doing with their money and what's the actual impact of the money that they're borrowing from investors. So, but first of all, I wanted to really focus on, a lot of companies are starting this. Well, we started it a long time ago because we thought it was the right thing to do. When I was working in Kommunalbanken in 2010, when we launched the Green Bond Program, we actually provide a subsidy on the loan. So we were raising capital at the same level, the same price of the capital we were raising, but we were subsidizing the loan because we just wanted to energize, to catalyze more green investments in the commune and the fylke. But I really think that now we're starting to move towards the concept, and it's taken a long time. And for me, it sounds very strange, but this idea that climate risk is credit risk. And it's taken a long time for really the global markets, ratings agencies, regulators, banks especially, to realize, to make this connection between climate risk and credit risk. And here you can see this starting to happen. So the ratings agencies are now starting to wake up to this fact. So over the last year, this shows if you can see, S&P, so they did 717 ratings over the last 2 years where environmental and climate risk were a material factor in the analysis, and 106 which led to a ratings actions. So you can see, this is where climate risk and a company's approach to climate risk led to a downgrade or an upgrade. So you can see, for the most part, it's a downgrade. So companies are not doing enough with respect to their exposure and how they're managing climate risk on the balance sheet. But what's interesting as well, there's a possibility of upgrade as well. So if you are managing it well, there's a potential for upgrade. And really, when we think about ratings, we think about the cost of capital. You have an average cost of capital for a AAA rated borrower, and you have an average cost of capital for a BBB rated company, depending on which sector they're in perhaps. But generally speaking, rating means cost of capital. The higher rated you are, the cheaper you can do financing, basically. So I think this really does, when I show this slide to corporate treasurers, they start to wake up. They start to think, okay, well, this is, now we're talking the same language. So I think the fact that ratings agencies are waking up to this, it has obviously negative effects, as you can see, but it has positive effects as well. One very good example, there's a Dutch logistics company. So they are very much a buyer of warehouses. They construct warehouses in airports and logistics centers in the Netherlands. They created a green bond framework, and through the disclosure, the additional disclosure that comes with that, in terms of what are we doing with, we're now basically telling investors that this capital that we raise in green bonds is going to a certain type of real estate, commercial real estate, that is higher quality, there's more energy efficient. So investors are seeing that, okay, we're focusing on better quality and more energy efficient premises that we're investing in, and that we're disclosing more information. They got a ratings upgrade. So this is ratings positive. So the fact that this company established a green bond framework was ratings positive. So there's real examples now in the market where you can see that this level of disclosure and focus on higher quality stock, if you like, or higher quality properties in this case, leads to a better cost of capital. So that's credit risk right there, and climate risk being credit risk. If you take a little bit closer look, how much are we talking about here? How much actual, how much debt in this case is at stake? And so this portion here, this red and orange, so this big section here, this translates to $2.2 trillion of rated debt that is at elevated risk with respect to environmental risk. So here you've got utilities, power companies, oil and gas, steel, building materials, so I'm talking too fast, building materials, oil and gas, automobile manufacturers. I have to tell myself to slow down, apologies. So you can see this is a huge amount of debt, $2.2 trillion that is immediate or emerging in terms of risk and downgrade risk, if you like. So the more that companies are prepared, the more they are disclosing, the more that they are talking about, okay, well, even if we are a brown company, because Agatha mentioned, we have to focus not only on the green, we have to focus on the brown as well. But brown companies can make a difference with respect to their disclosure of information. How are you managing this? What are you doing? I mean, every company has a role to play, even if they are brown. And you may think this is a bit naive, but a company that discloses what are they doing? What is that company? Every initiative that they are doing with respect to energy use, recycling, energy efficiency in the company, you're better prepared for what is coming down the pipes from credit perspective, but also, as we'll come to later, and as what Agatha mentioned, from a regulatory perspective as well. So those companies who are prepared and are disclosing more information, because you're going to hear this word a lot, disclosure, those are the ones that are going to be better prepared in the future. I mean, one example is this case in America, the Pacific Gas and Electricity Company. So this is the electricity or utilities company that covers California. They've just declared bankruptcy because of the wildfires that hit California last year, causing fatalities, causing massive disruption and effect to the environment and to people and to the infrastructure in California. $50 billion of debt they have on their books. They've just declared bankruptcy. So this, if you like, is being unprepared, having insufficient infrastructure. Now you could argue it's perhaps not all PG&E's fault. It might be a case of the government not investing in necessary infrastructure when it comes to forestry management. But regardless, they are basically, in the lawsuit, it's basically saying you have not prepared your infrastructure sufficiently enough to cope with these types of natural disasters. So that's a real-life case where we're actually seeing a company going bankrupt, 50 billion of bondholders out there going to be slightly annoyed. And, how do you think pricing for a company that's in the same business as PG&E is going to look today, having seen, it's only going one direction, right? So this is an interesting chart, I thought, because this is showing you can see the margin for clean energy in green, of course, versus the margin on oil and gas, so coal loans, if you like. So think of PG&E again. The likelihood that that's going up is probably going to increase as a result of events in the market like that. Now, you could argue, this is due to investors, investor sentiment, if you like, reallocation of assets. But either way, I mean, this speaks volumes for me. Starting to see it in the green bond market as well. So if you look at this chart, the black line is an index of green bonds. So it's all the bonds that meet certain characteristics, like $250 million in size. So it's a basket of all the green bonds that meet certain criteria. So it's a large proportion of the green bonds that have been issued so far to date, versus all the bonds, so conventional bonds as well. And you can see this outperformance now. So imagine you're an investor sitting on a portfolio of green bonds. You'd be making more money on that portfolio of green bonds than you were on a portfolio of just regular bonds. So you're starting to see this price discrepancy, if you like, with holding green versus just holding regular bonds. Now, again, it doesn't mean that you're getting better price on day one, but it does mean that you're probably reducing your cost of capital over time. So you can translate this over time into a reduced cost of capital by issuing green bonds, I think. Now, again, there's no difference in the credit risk. So let's say you have let's say Kommunalbanken, just pick an example, issues a conventional bond and then issues a green bond. The credit risk is exactly the same. So there's no pricing difference in terms of credit yet between a Kommunalbanken green bond and a Kommunalbanken conventional bond, right? But investors choose to buy green. If given the choice, I mean, what would you do? Do you buy a bond that is exactly the same credit risk that you know is going to a specific set of projects, renewable energy, clean transportation, or just one that goes to general corporate purposes? And you're getting the same return, and in addition to that, you're getting information that you wouldn't get normally as well. So I think investors, and there's an article in the Financial Times today which talks about this exact point. What is the lure, or what is the attraction of green bonds? And investors are saying disclosure, i.e. information. So you're getting more information, and that's why I think investors are willing to pay a little bit more, because they're getting that additional level of information that comes with a green bond. They're getting that disclosure for free. So what's driving this? These are just some of the examples of what's driving. So we don't have, kind of black and white regulation that's coming down the pipes with respect to the definition of green and the definition of sustainable finance. But I think what's interesting is you can see the private sector is taking the matters into their own hands in a way. Agatha mentioned, there's a significant effort of companies to really show how they are moving, how they are supporting the transition, and really trying, using their companies to align to their sustainability strategy, their climate strategy, whatever it is. So you can see here, this is the number of companies that have committed to 100% renewable energy under the RE100 initiative. That's pretty steep, from 13 in October 2014 to 158. Again, this is voluntary. Also, another driver is regulation. Here you can see, in 4 years, we've almost doubled the amount of regulation that applies to green and sustainable finance. So again, this idea of fail to prepare, prepare to fail, it's coming. Now, what shape it takes, how long it takes, it's a little bit uncertain. It's, the EU is moving very fast, but there are still problems, there is still much discussion with respect to what the actual regulation looks like, but it's definitely coming. Again, we got more pictures of all of the regulation that's coming, but I think the key to remember is, as Agatha mentioned, I think the two things I think that all of this regulation focuses on is about the definition of green, or the definition of sustainable finance, so what is green and what is sustainable. And there, the EU is starting with green first, because that's really more of a known entity as a result of the green bond market, really. So they're using a lot of the definitions and the descriptions, or the taxonomy of what's been financed in the green bond market as a start. And then they'll move to social things, social projects, etc., health, education at a later date. But they'll start with green. So that's disclosure, a description of what is green, a taxonomy of what is green, and then it will be easier for us to be able to connect our financing to those definitions in theory. The other part is reporting. So what the TCFD, the Task Force for Climate-Related Financial Disclosures, and the new EU regulation is really trying to focus on is, what is the exposure of the financial ecosystem to the natural ecosystem in a way. How are we exposed to each other, and what exposure do we have, and are we ready? Are we stress tested? They really focus on this, stress testing the balance sheets of financial institutions with respect to severe weather, as an example, or an increase in temperature, etc. So you're putting your balance sheet through the filter of a extreme, climate scenario. So that's how we prepare our balance sheets, and that's what banks are really starting to do as a result of the work of the TCFD, which I think will be translated with respect to the regulation that we see in Europe. This is my last slide. I've just run out of time as well. But it's not, I think what's interesting is it's not just bonds. And there's a lot of activity going on with respect to other financial products. Obviously, you can see the growth of the bond market. In fact, the green bond market came to $185 billion last year. So this is a little bit outdated, I apologize. But you can see there's growth of a variety of products now which incorporate sustainability into their terms and conditions. So you have green mortgages now. SEB is financing green mortgages. And again, I'll come back to this point that I mentioned at the beginning. We are not doing it because it's the right thing to do. It is the right thing to do, but we think green mortgages and green buildings and more energy efficient properties are just better credit risk. So you have to avoid this use of subsidy in a way. You just have to think of it in terms of it's a better economic risk, it's a better credit risk on the balance sheet, is what we believe. So we're providing a better rate of financing for green, green properties. But I think the final point I'll make is the sustainability loans. You're seeing companies who are linking the loan terms, so i.e. the rate which you pay on a loan, to how well you are doing with respect to your emissions targets. So we have Stora Enso, for example. They basically have an emissions target, and they set a rate on their loan terms to basically linked to the performance. How are they doing relative to their targets? So if they don't meet their emissions targets, they are penalizing themselves. So they pay a higher rate. So they're really being very ambitious with respect to the financial products they're using, and penalizing themselves in a way if they don't meet their climate ambitions. And I think you'll see much more of that. The flip side of it is that we also work with products, let's say supply chain, for example, where you try to encourage your suppliers to become more sustainable. So essentially you give a better rate for a supplier in your supply chain that improves their sustainability profile, if you like. So the more sustainable practice they incorporate, the better ranking or rating they get, and the better rate of finances or the better terms of trade they get as a result. So there are ways to penalize, there are ways to incentivize as well. So I think we'll see a lot more of these type of loans coming into the market. So I'll stop there, and just to summarize, I think it's really just important to focus on this word disclosure. I think that's really what the regulators are looking for. That's what investors are looking for when they come to putting capital to work. So thank you.
Ben Powell.